Anthony
Exactly.
Scandariato and Brian Leonard. Welcome to the Capital Raiser Show, man. I'm super excited to talk to you guys. You guys are based out of New Jersey. You guys are working on some multifamily. You guys consider yourselves a boutique multifamily operation. That's really cool. I haven't heard that before. Welcome to the show, guys.
Thanks for
Thanks
having
for
us.
having us.
Cool, man. I'm really excited to jump in. I do want to request from the audience, if you like the show, please give us a 5-star rating. But with that, we'll jump right into it. So tell us a little bit about Red Knight Properties and what you guys do out on the East Coast.
Yeah, Brian.
I can tell you a little bit how I got started. You know, I was a football player, got a scholarship to Rutgers University, originally from upstate New York, but had a pretty good college career. And then from there, I ended up getting drafted in the second round of the St. Louis Rams. Played there 2 years, and then got traded to the Cincinnati Bengals, played there 4 years. Then my head coach, Greg Schiano, went down to Tampa, got the head coach a job down there. So I followed him down to Tampa, played there for a year. And then my last year I played in New Orleans. And then after that, I'm like, what the heck am I going to do after football is over? I ended up staying home with my son, being a stay-at-home dad for 2 years. And then I was super interested in real estate. So I ended up reading a ton of books. One of my teammates was in real estate, worked for Vision Properties, and he asked me to come in, meet his boss. So I met his boss, and actually Anthony was working in the same company. So I got talking to Anthony on the side there, and we're talking about multifamily properties and exactly what I was reading about. We said maybe the next deal we can do together, and we did a deal, and it was in Chester, New Jersey, and we did a great job on adding value to that property. Ever since then, we've been growing. We've been growing pretty fast, and now we're at around 120 units. We're excited, and we're growing pretty quickly.
That's fantastic. I love it, man. NFL player turned syndicator. That's really cool. So real quick, Brian, tell me, what books were you reading? How did you master the syndication? Was it more of you partnered with people? Did you raise all the capital, or did you have your money from the NFL put into the deal?
Yeah, so one of my favorite books was Multifamily Millionaires, and it's a great book. Just teaches you the basics of multifamily. You know, I had no experience in this a year and a half ago, and now I'm syndicating deals with my partner. And Anthony had a ton of experience and knowledge, so he helped us grow. And obviously, I had some capital behind me from the NFL to help us grow also. So we made a great partnership, and we did, out of the 100 and something units we own right now, around 70, 75 of them are units that we own on our own. And then we syndicated a deal with 51 units. At a point, you run out of capital, or you don't want to put too much capital into one asset. So that's when we started syndicating deals. But, you know, we got up to around 80 units on our own. You know, I'll tell you a little bit about our first deal. It was a deal in Chester. It was a great deal. It was rents were super under market. I think on average around 750. And we went in there and we just knew, like, wow, this is a great deal. It's undervalued. It's easy. We can go in here, make minimal capital improvements, and raise the NOI and raise the value of this property. We end up buying that at like a $95,000 NOI, and we turned it into a $157,000 NOI, and we refinanced. We bought it at 1.285 million, refinanced at 2.1 million exactly at 1 year. So almost double the value of the property in a year. Actually, we're stabilized at 6 months, but you got to wait a full year seasoning period to refinance with a bank, and pulled out that capital, put it in some new deals, just rolling from there.
Very cool, man. So let me ask you this, Brian. What was going through your mind with your first capital raise? Was it pretty easy? Was it hard? What was your process? How did you get through it?
To be honest with you, we raised it pretty quickly. We have a great network. You know, we build up a reputation throughout our life, and people trust us and respect us. So when we went out and started asking money, we also had a great investment summary put together, a PPM put together. It was very detailed, and it was very easy to understand. So, you know, non-sophisticated investors could go in there and look at it and be like, okay, this is my return, or this is the waterfall structure, or this is the promote, and they could understand it. We ended up raising on our first deal $1.3 million, and we had fully committed in like 10 days. But that's due to, you know, the relationships we have, the network we have, you know, just having a good reputation around this area. It was fairly simple on the first deal.
Very cool. And how big do you want to get it, Brian?
You know, I want to keep growing. Like anything I talked about a while back, it's like we wanted to keep doubling every year until it gets to the point where it's not fun anymore, which I don't know if we'll ever get there. No, but I enjoy it. We both enjoy it. I know. We just want to keep growing and growing and growing. And it's getting easier, too, because we're getting our systems in place. You know, we have a property management software system called Buildium, where it puts everything under one roof. And it's been good for us just to, you know, keep everything. We can, you know, anytime we need it, we can pull it up and it's available right there for us. We don't have to go searching for it. That's the thing too. We're not only building this real estate company, we're building a property management company also along the side of it. And right now it's just us two. So we have been super busy, but we know there's a light at the end of the tunnel. And once we get all of our systems completely in place and all of our vendors in place, it's going to be a smooth sailing after that.
Very cool. Let me turn it over to Anthony. Anthony, why don't you tell us a little bit about how you guys created your relationship, what you guys' role is within the organization, and we'll start with that.
Sure. So I think Brian touched on it. It was a great job, but I think Brian touched on it a little bit. So I worked for a institutional, it was almost like a private equity real estate sponsor that was focusing on Class A office buildings up and down the East Coast. Through my networking during my time there, as Brian said, we kind of built up a little network with people who trust us and, knows, we produce and we do what we say what we're going to do. And, like Brian mentioned, I met him through a friend, just through my current work. We grew the relationship from there. And at the time I was buying, and for your listeners, this is a great way to start if there's not much experience, but I was buying like 2-family homes that I would reposition. Whether it's I had to go in there and evict tenants out, clean up the place and get new tenants in. I had a couple of those under my belt, and I didn't want to stay in the 2 to 4 families anymore, because even if let's say someone was paying $500 in rent for a unit on a 2 to 4 family and you raise it to $1,400, okay, but that doesn't mean the value of your building, is going up, because it's not looked at the same way commercial real estate is. It's more of the sales. If the house next door never sold more for $300,000 and you bought yours for $280,000, even if you raise the rents, doesn't matter. There's really not much value I saw to keep going with the 2 to 4 families, although it's great cash flow. But we're at the point in our lives where we want to really create a lot of value. That's how our relationship started. And then to answer your question about the roles, we're kind of both doing everything, because it's it's very small. It's just the two of us right now. We're kind of, in terms of the capital raising, we're each, I think on the last deal, I think we each raised about half, like each of them was from half of our networks each. So it was great there. Brian's really good with the overseeing contractors, some more of construction management. I'm more, well-versed in the finance aspect. I negotiate with the banks and, help really craft the PPMs and deal with all that. So that's kind of how it's evolved. Hope that answers your question.
Yeah. So, and then you guys mentioned that you're starting your own property management company. So that's typically referred to as vertical integration, where you have your own property management company within your own multifamily syndication company. Why did you guys decide to do that? How many units are you currently managing with your property management company?
Yeah, so everything. So we manage everything ourselves, because, our philosophy is if we're buying a value add deal and it's local, so within an hour or even a couple hours, all our properties we own are within like a half hour of where we live, both of us. So that's a big advantage. I know a lot of people don't have that luxury and they third party the management, which is fine. And they buy in Florida and North Carolina, et cetera. But I think we just have that locational advantage because of where we're located right now. That's a big thing. Like I was saying before, if we're doing a value add deal, we really want to be on top of it until it's stabilized. And then we'll have to think about at some point, okay, maybe we'll third party once, we do a refi or whatnot and get most of the capital back to kind of, lessen the burden for us. But we want to make sure we've been at the syndicated deal Brian just talked about. We've been at the property almost every other day, just trying to mark to market the tenants, make sure the contractors are doing their work. So we've been there pretty much every other day. We're going to continue to do that until it's stabilized. So I think with value add, it's a little different, but it really depends on your infrastructure.
Are you guys typically looking at B and C class, heavy repositioning, or just kind of light remodels? Do you guys have a business model for that? What do you guys prefer?
I mean, if we look at mostly B and C class, value add properties that are already cash flowing, depends on what the project needs. Like the deal we got in Chester, we were able to raise the rents a lot because they were so below market with very minimal capital improvements. I think our capital improvements was about $25,000 for that project, which is very small. I think we did a kitchen, the cabinets, countertops, painted the entire unit, and redid the bathroom. And the outside, the town is a beautiful town. It's well respected. People want to live there. It's a historical building, so there's not much we did to the outside, just except repaint the outside. and just kind of touch up some things, make it a little bit nicer. Now with our Newton deal, our first syndication, that was more of a C, probably a C minus type of product. You had to change the reputation. The first thing we wanted to do when we went in there, we had to change the perception. We had to go in there and change the exterior. We're redoing the sidewalks right now. Took out all the sidewalks and putting new pavers in. We're power washing the entire building. We're putting new shrubbery, bushes, and just making the outside look nice. Some benches, just to change that perception. That's the first thing you have to do when you go into these type of properties, because if you just go in there with no change and all of a sudden you're raising rents to market, people are going to have a hard time with that. When you go in there and you're showing that you're making improvements to the property and you say you're going to raise their rents $100, $150, $200, whatever it is, they're a little more accepting of that. Most of these properties that we buy, there's a huge loss to lease where the rents are so below market where we could go in there and just raise the rents. And if the tenants could go and look for another property or another unit in the area, and they're not going to be able to find anything for any cheaper because that's market. But what we want to do, we want to add as much value as possible, exchange it, improve the exteriors, and then go and redo the interiors as the units turn. The tenant can pull up to the property that's never seen this property before. They'll see a new monument sign. They'll see all the new renovations of the exterior. Then they'll walk into the hallway, a common area space that's redone, walk into the unit that's completely redone, and be like, okay, this is a place I would love to live. But they don't really know that the rest of the property has maybe not as desirable tenants as you'd like, or the units in the other part of the property are not that great. So it's just basically change that perception and raising rents as high as we can.
And then Anthony, do you guys want to stay in that area where, close to where you guys live, investing in your backyard, or do you guys foresee going into new markets?
Yeah, I mean, if you can do it, then great. But, I'm sure, in New Jersey in particular, it's very tough to find good deals, although we've been able to do so, at least for now, I'd say within the tri-state area. And, if opportunities come up in different markets, we'll have to get more educated. We'll have to, build out our teams in those different locations, which takes some time. So yeah. I would say, sticking within like 1 to 2 hours right now is probably where we want to be. But, and another advantage to self-managing too is if you're able to be successful with managing on your own and overseeing construction, et cetera, you'll be more comfortable to do the third-party management when you want to expand to other markets, because you'll know what questions to ask, the property managers, you'll know exactly what they need and what you need. I think it'll be easier to really understand and kind of have a expansion plan to other markets once we really execute on all the value add deals that we're doing. And we have been so far. So it's almost like just a stepping stone in the business once we do want to expand.
Yeah, that's where we're at too. Actually, my company, Bakerson, we're a smaller syndication company based out of Arizona, and we've pretty much done everything in our own backyard too. So it's all been Tucson, which is an hour south of here, and in Phoenix. I actually interview a lot of people on this show who don't live in the same market where they invest. And I always try and figure out how do they do it? How do they get the boots on the ground? How do they outsource that? But I'm not sure that it's the easiest thing to wrap your mind around if you feel comfortable doing stuff in your backyard like your company and my company does. That's kind of interesting. What can you tell us about the economic conditions, the market drivers, things that are happening on the East Coast? You guys might be some of the only people that I've interviewed that are investing in that area. So a lot of us are in the dark about what's going on out there, what it's like to buy a property, what's the price per unit, are the rents going up, or is it very stable? Tell us a little bit about the East Coast investing.
Yeah, you can start with that. So it really depends where you are, obviously, and what state you're investing in. So we're investing in, at least for the time being, northern New Jersey. In northern New Jersey, rents on average, they do go up every year. You're within an hour of Manhattan, Midtown Manhattan. So there's always that, economic driver. In general, a lot of municipalities do have rent control as you get closer to the city, and it's harder to do value add deals. So that's why, there's a lot more development deals going on in cities like Newark and Patterson, Elizabeth, once you get really close to the city within 15 minutes. So to buy existing and to do a value add is very tough. On a price per unit basis, on average in northern New Jersey, where we're buying in like the hundreds a unit. And that's for 1, 2s and 3s. So anywhere from 100 a unit for like, B and C product all the way up to, I'd say, 300 a door as you get closer to the city, Hudson County, Hoboken, Jersey City, that whole area. That's pretty large range. But where we're seeing opportunity is, buying the existing kind of workforce housing play and investing in those areas that do have upside and growth and that are somewhat recession proof. And when you look at the historical trends, when the last recession hit, what was the vacancy on the one bedrooms, what was the vacancies on the twos and the threes and that specific area. And in the area that we're investing in, there's very little vacancy because it's one of the cheaper places to live in within an hour of Manhattan. That's why we like the specific market where we're investing in right now. But it is tough to do deals in New Jersey, especially value add, because the cap rates are so low. The deals we're buying right now, at least at a 6 cap, is where we're buying. Average cap rates are like 5 or so, and that's with some value add or even stabilized, they're in the 5s. So it really depends on what market. But if you buy, for example, if you buy a 6 cap and once you're done with your value add, you can get it to a 7 or 8, you'll be okay, regardless of whether there's a downturn or not. So that's kind of our investment thesis for at least the deal we just bought. So
Brian, break down the type of buildings that you guys look at. Are they brick built? Are they pretty old? Are they 4-story buildings? Are they taller than that? Are they 1-story? What kind of assets do you look at? What is it like to purchase out there? Because a lot of us build, stick build type of, stucco on the outside, frame board apartment complexes. In Phoenix and in Tucson, occasionally we have block built apartments, which I prefer because they're like, little tanks. What kind of properties do you look at out there on the East Coast?
Personally, I like the garden style property. The brick exterior, it's a little bit more hardy, and I like the community feel that those garden style apartments have. So that's what we like to focus on. I mean, there we have some in that same property we bought in Newton. There's a stucco building, and then there's 3 garden style buildings, and then there's 3 single family homes in the same complex, along with a wood frame 2-story building. So, but ideally, if we can buy anything, it would be the garden style type of property. But really, I mean, in New Jersey, anything that has a decent cap rate, like our Chester property, that's an old building built in the 1800s, very historic, and that's a 2-story wood structure. So it depends on, what we're buying, what kind of value we can add to it. Are the rents under market? But if we're going to focus on something ideally, we'd like to buy the garden style brick buildings.
Okay, so tell me about how you manage your investor database, how you communicate with them as you're growing with new people and getting new people into your database. What are you doing to expand on that? And then what's your first communications with those people? Do you start educating some people, or do you have a system where some people receive certain information and other people get different information?
So in terms of the investor relations, it's like you just said, yeah, it's definitely starts with education for new investors that don't really understand how real estate works or never invested in real estate, whatnot. So it definitely starts with education. Obviously, for your listeners, I'm sure a lot of them know about the different types of syndications, 506B, 506C. We've been doing 506Bs. That basically means if you have a pre-existing relationship, we know all of our investors personally because, we're still at that point where we're doing, once you get past, sometimes like a $3 million raise or so, it gets tough with the 506B. You might need to do the 506C. For that type of syndication, everybody needs to be at least sophisticated. And that's why we break it out very nicely in our investment summary. And, we personally walk all the investors to our property. But once we close on the property and the ongoing relations, we use Buildium, at least for now, we upload basically everything. So all the financials, all the quarterly reports, the K1s will be distributed on there, all the distributions. We're currently sending out like monthly updates on how we're doing with the property, just a business update, not a financial update, where we are, how many vacancies we have, what did we rent this unit for, what was it rented at before, how much capital have we spent. So we're doing that monthly. So, with pictures of some of the, renovations we're doing. If I was a passive investor, I would appreciate that. So that's why we're, continuing to do that. In terms of like the reporting, most of that from a sponsor is done quarterly, and as well as the distributions if you can pay it. So that's kind of how that's structured.
Okay, very cool. I received a compliment yesterday about my podcast where somebody told me that they had never heard another podcast where somebody is actually learning, and the presentation style of the podcast is where somebody is learning as they're interviewing the person for the purpose of getting better, smarter, and faster and good at raising capital. So I'm actually curious about things in people's businesses, and one of the things that I really want to dive even deeper into is, because we need to implement these systems ourselves, is what kind of a computer system or infrastructure you are using so that you can communicate with your investors on a regular basis. Do you just reach out to them on the telephone? Is there an email newsletter? What kind of communication is being sent out? How often do they send it?
We send all of our updates through MailChimp. That's what we use right now. There are other softwares out there, CRMs that can help you out and be a little bit better, but they're pretty expensive. We're looking into those right now. I know one of them is Juniper Square. We've looked into Juniper Square, and that has everything you'd need to communicate with investors, raise money, send all the paperwork, documents. They can actually even send money through that system to fund your deals. So we're in the process right now of finding the best option for us. Since we're so new, still growing, and finding what systems work best for us. We're trying to find one that is a little bit less expensive than Juniper Square, but we need to find something like that for sure. But right now we're just, like I said, MailChimp for updates, and then, phone calls, regular emails. That's how we're keeping contact with the investors.
Okay, cool. So we just recently implemented on the show a speed round, and this is going to be interesting because I've never interviewed two people simultaneously. I know you're with the same company, but what I'm going to do is I'll probably ask 3 or 4 questions to Brian, and then I'm going to turn it over to Anthony, but we're going to get started real quick. So it's kind of just the fast answers. But Brian, boom, boom, boom. Tell us, what is your favorite food?
Steak.
What is your spiritual philosophy?
Just be a good person. Treat people like you want to be treated, and respect everybody.
Okay, and what's your favorite NFL team?
The Bengals.
Okay.
I played there the longest, so it has to be the Bengals. I grew up a Giants fan, but they paid me the most, so I got to stick to the Bengals.
Okay, and then what's your favorite real estate book?
Multifamily Millions. I think it's by David Lindahl.
Okay, yeah, Lindahl. I believe he just retired. Okay, I'll turn it over to Anthony. Anthony, tell us, what would you wish you would have known before getting into real estate? If you could go back in time and tell yourself some advice, what would that advice be?
I guess to just don't be afraid, and don't be afraid to go bigger, quicker. I think that's I think I would tell myself that, because I was very, very nervous to get into larger deals for a couple of years after I bought, my first 2 family. But I probably could have pulled the trigger maybe a year prior.
Okay, what's on your radar for places to travel to? Where would you love to go?
I've been to Italy, but I'd like to go back. Ireland's on the list as well, and to see the rest of our country, the U.S.
Okay, and then who do you admire as a mentor, or someone who has taught you real estate who you've never met but maybe have read some of their material?
Robert Kiyosaki's always, great. He's not specifically real estate, but he has a few real estate books as well. But Rich Dad Poor Dad is definitely one of my favorite business books.
Very cool, guys. All right, so we'll go back into the real estate side of things. Let's go into raising capital a little bit more. You said that it was a pretty easy process because you built some relationships. Why don't we discuss, for example, the process of going from 50, or staying with, in your case, 506B, but you guys are contemplating going into 506C because you think it might be easier after you have a $3 million raise. Tell us the philosophy behind that. Now, I'm not sure that everybody would agree with that concept. Have you guys spent a lot of time thinking about that? We just switched to a 506C model, and it's challenging because we have been raising capital the way where you find the deal and then you raise the capital, which really you should have the capital raised before you find the deal. But if you were to go into a 506C model, tell us about why you would go that way.
Yeah, I mean, at this point, we're not going that route. But if we were to do it, it would almost be like a test, kind of like what you just mentioned. You guys just switched over. It would be more of a test to see if it's more successful than the 506B. But realistically, all the investors, in my experience, generally know the sponsors, at least in some capacity. I mean, there's obviously the differences. 506C, everybody has to be accredited. So you can't have non-accredited investors. In our deals, we have, for the most part, everybody's still accredited to begin with. Some of them aren't. It's really deal specific. But I think once the deals get a little larger, then that might be an avenue. We were just looking at a larger opportunity for the new year. We were trying to tie it up. But we would probably bring on, a co-sponsor or a co-GP to, help with the capital raising and help with the infrastructure. And you might not have to do a 506C at that point. 506C, there's a lot of compliance you gotta deal with the Security and Exchange Commission. It's expensive. I mean, you're very aware, upfront cost and, a little bit more overhead for the company. But I can't say I have experience with it because I haven't done it. We've had the network to do the 506Bs right now. So
Yeah, I interviewed a gentleman named Brian Burke who's been syndicating for 30 years, and he did 506Bs the entire way until he wrote a book, and he was nervous that the book would be seeking money, so he wanted to protect that in all ways. So he changed to 506C. But I think that you could very successfully do 506B as long as you continue to build enough relationships prior to the deals or have enough of a database before you get into a deal. Because then I would say that would probably be a little bit better because you're not restricted to the accredited only. Unless you have a lot of accredited investors in your database, that would probably be the better option. The nice thing about having the 506C, though, is that you can talk about your deals. We've been recently introduced to a webinar campaign where we talk about all of our previous deals, and that's it. And then people find out about who we are. They learn our track record, why multifamily, et cetera, et cetera. And then we start building we're starting a completely new investor database from our new infrastructure that we're implementing on communications. But anyways, I don't think that you always have to talk about your existing deal. If you can talk about your previous track record and get that information in front of enough people, then a lot of times that's enough to get them to know, like, and trust you.
Exactly, and we've seen that ourselves. There's a presentation we gave the other week, and we weren't soliciting it at all, and that wasn't even our intention. We were just kind of talking about, here's what we do, and here was our previous deal. Here's an example, and then people just naturally come up to you after and say, hey, let me know about your next deal. I'd love to take a look at it. And at that point, you have a pre-existing relationship as defined by the SEC. It's a little bit different, but it's a little more of a hustle, and it's less, like you just said, you don't have the direct avenue to post your deal on LinkedIn or Facebook or Twitter or Meet, whatever the case may be. When you're not doing the 506C, you're kind of restricted to your pre-existing relationships. So some investors are, part of my friends for more pain in the ass than the others. So we like to, like I said, know all the investors, at least personally, because you may have a couple people in there that you don't even know when you're doing a 506C, and they send you questions every day about why isn't the basement leased? Like, just stupid stuff like that. That's why we've been sticking with this, and we'll see what happens. I love to, when you're done with yours, I'd love to hear how yours went.
Yeah, I'll be happy to share that information. I'm sure I'll talk about it on the show. I'm curious.
I think another problem too, I want to touch on the 506B. I think we haven't ran into this problem yet, but I'm pretty sure you're only allowed to have up to 35 unaccredited investors in the 506B. So if you have a capital raise of a couple $1 million, $3-4 million, you might run out of space. You might have to go into a 506C because you can't raise enough money with only 35 investors with the 506B.
Yeah,
another issue could
run into. Minimum's
into.
low. Yeah,
that's a good point. Thanks for bringing that up. I'm curious about you guys' stance on social media. I don't see a lot of major activity on social media from the West Coast or from Arizona that's happening in the tri-state area. Tell me about, maybe you guys see it differently because you guys are connected to completely different circle of influence than I am. But how important is it to have a social media presence, to be online and have visibility for people in that area?
I think it's still pretty important. We're still growing our company, and we have a Facebook page, we have a LinkedIn, we have our website, and then obviously we do podcasts, which is what we're doing right now. People see that on the East Coast too, and we do have people that have reached out to us. Oh, wow, it's a great podcast, or I have a question, or would love to get in any of your projects. I think it's pretty important, and we're probably gonna realize how important it is going to become, because it is a marketing business as well. Right? I mean, that's what it's transforming into. Both of us, Brian and I, would love to have more of a presence online, and we plan to do so. I know we kind of have we're kind of working in baby steps with that, and hopefully we'll be at a much more sophisticated place soon with our online presence once we wrap up, the deal we're working on. Yeah.
It could be. I agree, Anthony. I mean, we've been so busy over the last year. We've kind of put that on the wayside because we did have a big network to start with, and we knew a lot of people, accredited and non-accredited investors, to help us get started with our first syndication. But when you start doing big deals and you need, you want to market yourself, you got to get on social media. Social media is so important, and we really haven't focused on that yet. But we really have to start putting more emphasis on our presence in social media.
Yeah. So, I mean, Bakerson, the company that I work with, was the same way. In fact, they enjoyed being under the radar for a long time. But as they started scaling and realizing that they needed more and more money, and then they found themselves with no or very little presence online, they realized that they had to change something. So they actually brought me on board to help with brand awareness. And one of the things that I do is I go hit up a lot of conferences, do a lot of networking, share who we are. Hey, we may be only in our specific market in Arizona, and a lot of other people are investing in multiple markets in the Sun Belt region, Texas, et cetera, and they may not be aware of a small syndicator or a small time operator in a local market somewhere else that's obscure to them. But the more that I do that, and the more that I, with the podcast, people are finding out about us, I highly recommend finding somebody to if that's not your strength, man, outsource that. Have somebody write blog posts for you and posting for you. It's very cost effective. So that's one of my tips for the day. So you guys mentioned you want to keep growing. Tell us a little bit about your existing portfolio. How long have you guys been in business? What's the total unit count? How many total properties? Tell us a little bit about that.
Yeah. So our first property bought was in Chester. That was 10 units. And then we bought another property in Butler, New Jersey, and that was 11 units. Then Montague, we have 2 properties out there, 20 units total. Then we have one in Port Jervis, New York, that's 12 units. Then we have our deal in Newton, that's 51 units.
A lot of those deals, quickly. The first ones were joint venture capital, or they're not syndications.
Yeah, so all the way up until we did the 51 unit deal in Newton, New Jersey, all the rest of the deals were done just between Anthony and I, from the capital that Anthony saved up from working and the capital I saved up from football.
Very cool. And then, so are there larger apartment complexes on the East Coast, like 1,000 units or 500 units or 250 units?
Yeah, no, they're out there. Obviously, I get the email blast from the large brokerage houses when they do come up. Totally different buyer pool you have to deal with at that point. You're dealing with more institutional capital. Very low cost of capital, so it's very tough to compete. But they are out there. There's even some Class C product that's 200 units plus. We recently looked at 100 units. They are out there. So, it just really depends on where you are.
And then your niche going forward, Anthony, are you looking to stay within a certain unit count, like 75 units and under, or are you starting to scale and evolve? Or do you just want to master this one specific type of unit size and do a bunch of them?
Yeah, I mean, I would say both. I mean, we've been pretty good within the below 100 unit size, at least on a per project basis right now. Not to say we couldn't handle more, because I think we can, when the time comes. they're all relatively, in my opinion, similar, but everybody has a management company on site. At least once you get to the larger units, you got to have a contractor that can handle the scale. So I feel like you get to larger units as you scale the company. And that's what Brian was just saying. We went from a 10 unit to an 11 to a 13 to a 20, it's like, it's to a 50. So it is getting larger. So
at some point, do you think that you'll bring on other people into Red Knight Properties? I know you mentioned that co-GP was an option as you scale, which I think we're facing that too. We're looking at doing some joint venture or co-GP with some other companies. But do you think that the two of you guys can manage if you guys purchase another 500 units? Just the two of you?
500 units? What do you think, Brian?
If we're going to keep growing like we are, we're going to have to hire some people for sure. That's in my opinion. Especially with these properties that we're doing that need major capital improvements, we need someone to oversee the construction and the renovations, the capital improvements of these properties. With just us two, that'd be tough to do. But right now with a 51 unit property, doing that, it's fairly simple. I think also the acquisition of a property, if it's a 10 unit, a 4 unit, or a 50 unit, it's about the same amount of time. But when it comes to management, that's when it's different. I mean, that's when it takes a lot more of your time up. You're managing more people, you're managing more contractors. So that's what takes more time. So if we had a third-party management company and we found one that we really liked and we're just acquiring properties, I mean, we're going to acquire the biggest properties we can. That makes sense, that have, that are good deals because they're the same amount of work. But now we got to manage these properties too. So we got to figure out a happy medium.
At what point do you think, in terms of unit size, do you have an on-site property manager?
I think it makes sense around 100 plus units. Financially, makes financial sense. You have someone on there and a property manager right there and a maintenance guy right there. At the property we have right now, 51 unit property, we're not going to have an on-site manager. We have a super that we trust and we like, and he can do the small jobs around the property, but the jobs that he can't do when it comes to plumbing, electrical work and stuff like that. We have our vendors ready to go, and we have them set right up on our building system where if there's a maintenance request that comes in, we just send a work order out, one quick email, tell them, what unit, the name of the person and their phone number, and it sends directly to the vendor, and that vendor calls up the tenant and communicates with the tenant, figures out a time to, meet them there to get the issue fixed, and then they send us the invoice. And it's that simple, really, when it comes to that type of stuff, as long as you have your systems in place.
Are your properties close enough so that one person can manage going to the different cities if there's problems, or do you guys have separate people in different towns?
So we're really focused on Newton right now, and I have over 110 units there. And then also we're looking at another 100 unit property there. So if we can, we'll have, it's great to have the economy of scale, and it's going to be less expensive for us too in maintenance, because hopefully we can have one super for all 200 units instead of a super for every building, which will cut down our cost and raise our profits and raise our NOI. But right now the properties we have outside of Newton, Anthony and I we manage those. They're fairly simple to manage, and if there's an issue, we'll go out there, but we don't get too many phone calls on those ones.
Yeah, Ruben, the other properties that we own, we they were value add deals, and we already implemented the value add for the most part. So there's not much like boots on the ground anymore at those properties for us at least. So it's more of just collections and handling maintenance calls and whatnot. So not too bad.
What are some of the things that you guys are doing to increase income and decrease expenses? Tell me about some of the ways that you guys are making the spread bigger.
I'll start. So some of the ways we are increasing income is we're adding laundry facilities. So in our Chester property, we added a laundry facility, and we got a whole lot of income off that, but that's another way to increase profits. You can always charge if your building is in an area that's a very busy area, like in the middle of a town or something like that, where parking's hard to come by. You can always charge for parking. We haven't bought a building like that yet. In our property in Newton, we're starting to charge pet rent, and when we bought the property, they weren't doing that, so that's going to add value, along with a initial pet fee of $400, and then $25 thereafter every single month, and that's just added extra income. Also garage income. So we bought that property in Newton. We also bought is it 20, how many garages in it?
Like 33.
20,
It's a lot.
33 garages that were only being charged around $50, $75 on average for each garage. And we went in there and we're getting 175 for these garages now.
Nice.
So it's just increased. That's just value add right there that the other owner missed out on. Now we're going to add value and create, increase our NOI, and then obviously increase the value of the property. Some ways you can decrease expenses. You can always, if you think your taxes are too high, you can always contest your taxes and get your taxes lowered. We look at all of our vendor contracts that we have, the past owner had, and if there's any way we can lower that, where there's garbage, or so if we can lower the insurance. On our Chester property, we're able to lower insurance by a couple $1,000s, and in Newton, the property in Newton, we're able to lower insurance there too. So, there's always ways, and also what we're doing too in the Newton property. The last thing I'll touch on is there was a store that we're going to convert into 2 units, a 1-bedroom unit and a studio, and we bought that property without those numbers within the NOI. So that's just created value. And there's another spare unit that has no kitchen or no bathroom in it. It's on the hillside property, and we're gonna renovate those. It's gonna cost about $35,000 to renovate those. We're gonna put another studio in there, probably 2 studios, and that's just added value. I know it costs money, capital up front, but $35,000 is nothing compared to when you're gonna increase the NOI by $30,000 a year.
Very cool, man. It's been a pleasure to have you guys. Red Knight Properties in the house. That's really cool. Tell the audience how to get a hold of you.
They could go to redknightproperties.com, www.redknight.com. They can go to our LinkedIn page. They can go to our Facebook. They could send Brian or myself an email. We have a contact us form page on the website too. So our phone number's on there on the website, our office line, so you can reach us there.
Any last thoughts or anything that you want to share with the audience, or any things that you want to tell either a new syndicator or your existing investor partners?
I would say, just for the audience, gain as much knowledge as possible. That's so important in my opinion, because with knowledge combined with action, it's going to create opportunities. And then when you have those opportunities with execution, you're going to become profitable. You're gonna make a lot of money that way. So just educate yourself, add as much knowledge as possible, and do the best when you get those opportunities. Be ready, be prepared. It's going to create tremendous wealth.
Awesome. All right, guys. Well, thank you so much for coming on. I really appreciate both of you guys taking some time out, carving a little time to spend time with me here on the Capital Raiser Show. It's been a blast, and I hope to stay in contact with you and follow your progress on social media. I wish you guys the best success and lots of power in 2020. Peace and strength.
Thank you, Ruben. You too.
Thank you, Ruben. Appreciate it.
Man. You got it. Take care.
Do the best when you get those opportunities. Be ready, be prepared.